if you've got a basic plan, looking at this trade, the arrow at the bottom, that's your plan, right? The idea here is you're going to go and try and buy the double bottom, essentially. Market drops back onto the level at 65.83. You buy it to play the move back up, either to the recent low, 67.30, or the top of the recent range, 68.75. That's the plan. Now, where that is not a trade is the only thing that you could take from that is put a bid at 83 and get out at 67.30. Now, the problem you have with that is, of course, we don't get to 83. And the other problem you have with that is if you did get to 83, where's your stop? There's no defined point to place a stop. So whilst the plan is there, the idea is good, the viability of that trade is absolutely not there. You can't take that trade on. That's the way you have to think about it. There is no trade. All you've got is a decent idea that this could reverse. So this then comes back to making a decision and being able to say, right, we have now reversed and this is not a pullback. That's the crucial thing. I always get asked, how do you tell the difference between a pullback and a reversal? You can't. That's something that you have to kind of get over, if you will. At the point where I've got that purple arrow pointing to the chart, at that point, this could be a pullback. We pull back to the recent low at around about 66.40, and then we continue on. This could be a flag, and you can look at that down, flag, continuation. So it could be a continuation. It could be a reversal. Ultimately, that's what you're planning for. So you already know what you want to do. You can't buy the 83 because it never gets there. And the idea of, well, put your bid above the level. Well, if you're going to put your bid above the level, 84 then, 85, 86, 87. How about 95? How about 00? The putting your bid above the level isn't the solution because you can always be above the level to the point you're buying it up here. And at that point, evidently, it is not a trade. So the question really that you've got to answer here, and this is where an indicator is going to help you, is the reversal actually on? So what you're looking for is information that can now identify this is a reversal and say, now you can get into the trade. For somebody waiting to buy 83, they watch this trade go by, they've missed it, game is up. And if you're very sort of simplistic technical, you trade it off a chart, you come down here, you put your bid there, you go home and you never got filled, didn't get the trade. What you're really looking at here then is information that's going to help you out. Delta, I talked about this in the last video that I did, and I'll explain that trade in just a moment, a little bit more detail. But Delta's rising. Now, what this is telling you is buyers are quite happy down here to come in and buy. Now, of course, that doesn't mean that a reversal is on, but it's tipping you in that direction. You already like the idea of buying it on the retest of 83. You also are now seeing that buyers also like the idea because they're willing to go and hit into the offers. So things are stacking in your favor. It still doesn't produce a trade though. What's going to turn this into a trade then is being able to find a little bit more information from an indicator. That volume increase that you start to see coming in here, and in particular on the candle that breaks out, that's the trade that you're after. Delta's already going up. So that's ticked one box. You've bounced off the level. All right, you've not touched it, but that's ticked another. You're above the pullback high. That's ticked off a third. So now you've got a defined trade. That's what you're looking for. This is the precision. This is what the indicator's helping you with. The indicator's saying, yep, all of these things are stacking up. You've now got precisely defined edge on this trade. You're not playing it from all the way down here. And you can look at that and say, well, you've missed out on you've missed out on 80 ticks. Yes, you have. But you couldn't have got in down here for one. And two, do I care about missing 80 ticks when I can get the absolute straight line move here? No, I'm quite happy with the straight line move. Also, with relatively small risk, you can buy at 66. That's on the breakout. Straightforward breakout trade. Volume ticked up. The Delta punches up. That looks perfect. I showed you the order flow on a trade like this last week. That's exactly what you're after. You've got a clear stop. The stop goes below this high, the previous one. That's at 45. Boom. 15 tick stop then. And you've got a target The original planned target is 67.30 from the hourly chart. Target is reached, possibly dependent upon how it trades. You could then play for the other side of that range completely when it gets up there. That's something that we can look at next week when we look at order flow and how scalping can improve any trade. So we'll be covering that a little bit more next week. In this case, then, you risk 15 ticks, you get 70 tick payout. But that's all because the indicators have given you that edge. They've been able to say to you that, yes, this trade has gone from just a simplistic buy the level, and you can look at the probabilities of that working. But the probabilities of it working don't take into account the many times that it never actually gives you the chance to buy. Now you've got the trade. The indicator says go for it. You can play that break. It's all set already as to where you want to go. The plan comes into fruition. You get paid on that trade. And we looked at a similar version of this when I did a broader video the other day that some of you guys may well have seen. Now, this is using a similar type principle. Again, it's a reversal trade, and this is using indicators to improve a setup. What you've got here then is what I call a block reversal trade. Very similar principle. Market drops down, and in this sideways trade, you've got more people coming in to buy. Now, I know that people are always unsure as to how to interpret delta. In this case, what you've got to think about is, right, people are coming in to buy. Now, this is going to do one of two things. Either the sellers at the top of the block are going to hold for long enough that the buyers give up and the market rolls over, or the sellers at the top of the box eventually get pushed out of the way. The buyers keep on coming, push them out of the way, and the market explodes higher. That's what you're playing for here. So what you've got now is an opportunity to then play the break and then a confirmation of this as well. So this is about giving yourself options. From this view here, you're looking at playing this on the break of the range. You can play it as it breaks the range. So as soon as it comes out of the block above 25, you can buy it passively there. And you're looking to then play this straight the way back up towards this volume ledge on the profile, taking back this move. That's one way of playing it. But you're also looking for options as to how you can leverage this as well. That's where a footprint comes in. This is what I call a delta punch trade. You can use the delta on the footprint. You could be buying it as you come out of the range. That's around here, around 25. And the fact that you've got this imbalance of buying coming up the move anyway, that's positive. But then you get this delta punch. If you want confirmation of a move, this is what you want, this sudden jump in delta. And again, that's that little indicator that you'd like the trade anyway. But if you like the trade from a technical perspective, you're long here, it looks good, you sit in it and let the move go. When you get this, now you can add. And I'll show you what this looks like order flow wise in a little bit when we go and have a look at gold. That's how you can improve trades. And that's what makes a trade, or that's what gives a trade edge. It's that ability to leverage it up because you're using indicators that say, yes, now you can do it. Could I explain context? Yeah, I won't go doing too many questions, but the context from a profile perspective, and I love profile. I think profile is one of the best indicators. What you've got here then, this is the move down into the block. So the Z print, A print is the move into the block here. And then the B print is the move away. So the B print starts around about here. What you've got is what I call an elastic band trade. So what's happened then is market moves away from the previous range, balances, moves value lower, and then you get this continuation move. So when you've got that, that creates what I call an elastic band. No shift in value. That's your plan. The market should now go back up. This is what tips you to thinking, yep, we can reverse. So now you've got the block reversal, little block range with delta rising. All of the indicators start stacked together to say this is not just a reversal that may or may not happen. This has a high propensity to work. So that's the context side. You add the footprint, now you can leverage as well. So that's what I mean by indicator edge. You've got a plan already. The indicators do is they tell you this is a good plan. And today, this has got a much higher chance of working than on any other day.